We founded Antipodes in March 2015 as a high conviction manager of global and Asian equities, both long only and long short. We launched our funds in 1 July 2015 and we're very sort of enthusiastic in terms of how we manage the business, and we see the benefits of creating a structure of very tight alignment between investors and the investment team. The objective of the fund is to deliver absolute returns in a risk-adjusted sense over the investment cycle, 3 to 5 years, and to do it in a high conviction capital preservation approach. The benchmark for the global funds is the MSCI All Countries World Index, but we are in no way constrained by that index. We can invest in developed markets, emerging markets, and really our universe of opportunities are in large capitalization companies. So companies, we're targeting typically companies greater than $2 billion market cap. And in that sense, there's over 4,000 companies that are larger than $2 billion market cap. So there's a vast opportunity set for us to take advantage of. We see investment returns as a function of the business, the quality, the resilience of the business you're buying. And that is ultimately measured by the sustainability of its competitive advantage. And then it's a function of what you pay for that business. So that is our definition of return. Our definition of risk is a combination of stock level risk. So we control that by buying businesses cheaply. Margin of safety protects you from that permanent loss of capital, which is what real stock level risk is all about. But it's more than just resilient businesses, it's resilient investments. And that's the concept of multiple ways of winning. So your investment case cannot be dependent on just one single factor outcome. The second aspect of risk is going beyond stocks. It is the behavior of the overall portfolio. So when we're looking for opportunities, as a high conviction manager, we're only looking for 30 to 50 stocks in a universe of 4,000 companies. That means we can be very selective and we can build portfolios with non-correlated sources of alpha. So the next question is, why should you be able to buy those selective stocks at a discount to intrinsic value? And we think that happens because markets can tend to be irrational around changes in the environment that are impacting businesses. Those changes that we see typically fall into 3 buckets. They're either cyclical, structural, or they're broad socio-macroeconomic changes. It's when markets become irrational that you get the opportunity to buy the company, a great business, at a great price. The concept of resilience or sustainable competitive advantage must be subjected to ongoing tests, because the problem with really resilient businesses that are highly profitable is they attract competition. And in a cyclical framework, that typically means capacity or new competition leading to capacity expansion in an industry, and then when there's a small change in demand, that's enough to tip the industry into the shakeout phase. In a structural sense, it is a strong incumbent that becomes quite lazy, starts to feed off its profit pool, profiteer, and opens up a price umbrella for new competition. In both situations, it's really about challenges that are facing the business, whether they are technological or competitive or regulatory or simply management missteps. And that is what typically allows us, and only with a disciplined fundamental approach can you determine whether the impacts are permanent or temporary. But it's that's what we describe as irrational extrapolation around those factors that opens up an opportunity to buy a business, a great business, at a great price. So we manage concentration risk through two principles: minimum level of diversification, and secondly, diversified sources of alpha. So what does that mean? For us, the minimum level of diversification is 30 to 50 stocks. Why? Because beyond 30 stocks, you get most of the random benefits of diversification from a protection from unknown risks, the risks that you can't control. That gives you most of those benefits. Diversified sources of alpha is a little bit more of a qualitative assessment of risk, where we believe we can control and measure build-ups of similarity in the portfolio, and making sure that the portfolio will behave in a way where, if there is a shock, maybe it's a certain outcome tail risk event, we know where the concentrations of risk are, and we have diversified our alpha source sufficiently to protect against those sorts of outcomes. So we see currency as another risk that we need to manage. So when we buy a stock, we also buy a currency. As a part of our consideration of socio-macroeconomic factors, we consider that currency risk. And if based on our fundamental valuation models of currencies, if we believe the currency is significantly overvalued, and we do apply a higher margin of safety in that assessment because of the unknown risk around anything that is macro in its assessment, we will hedge out of that currency into a currency that we feel is more attractive as an evaluation sense. That is ultimately a strategic view, and so our currency views are very high conviction in that sense. We short sell for three reasons. Ultimately, drive alpha. Sometimes we also get the opportunity to hedge a specific risk on the long side. And also there are times when we want to protect the portfolio from tail risk. Well, when we short sell, either in single stock or in a index, we are reducing our net exposure to markets. In the case of currencies, we use typically forwards to reduce our net exposure to expensive currencies. So both of those combined have great risk management characteristics. The typical net exposure limit is 50 to 100%, and there's a gross limit of 150%. Now, the gross limit is a combination of the aggregate longs plus the aggregate short exposure. It cannot exceed more than 150% of the fund. So the fund suits an investor who's looking for exposure to global equities in a high conviction capital preservation approach, and is also looking for the benefits of shorting and currency management. In addition to that, there are those benefits of being able to gain exposure to industries that are not represented in the local Australian stock market, and also diversification away from Australian assets.